Today, we will be covering Chapter 17, Learning Unit 17-1, Concept of Depreciation and the Straight Line Method. First, we will discuss the concept and causes of depreciation. Next, we will prepare a depreciation schedule and calculate partial year depreciation. So what is depreciation? Depreciation is an estimate of the use or deterioration of an asset. It does not measure the amount of deterioration or decline in market value. It's simply a means of recognizing that these assets are depreciating or lowering in value. Depreciation is also an expense shown on the income statement. Asset cost. Asset cost is the amount paid for an asset, including freight charges. So if you buy a piece of equipment for $10,000 and then have to pay $500 to have it shipped to you, the total asset cost would be $10,500. Estimated useful life. This is the number of years or time periods for which the company can use the asset. They may use the asset longer than that, but the useful life is what we'll be using for depreciation purposes. Residual value, also known as salvage or trade-in value, is the expected cash value at the end of the useful life. So if you buy a vehicle for $20,000 and you estimate it would have a useful life of 5 years, and at the end of those 5 years, how much do you expect to get cash for that vehicle? $5,000? Then your residual value would be $5,000. Accumulated depreciation. Accumulated depreciation is shown on the balance sheet. It's the total amount of the asset's depreciation you have taken to date. In the first year of depreciation, accumulated depreciation will be equal to depreciation expense because you haven't taken any other depreciation except for year one. In the following years, it will be the prior year's accumulated depreciation plus the current year's depreciation expense. And we'll take a look at that in a minute when we prepare the depreciation schedule. Book value. Book value is the unused amount of the asset cost that may be depreciated in future accounting periods. You could also say book value is equal to the asset cost less accumulated depreciation. So how much you paid for the asset less how much depreciation you have taken to date on the asset. Book value cannot be less than residual value. You cannot depreciate an asset below residual value. At the end of the asset's useful life, the asset's book value is the same as residual value. You only depreciate to residual value. So what causes depreciation? As assets, all machines have an estimated time of usefulness simply because companies use the assets and the assets gradually wear out. The cause of this type of depreciation is physical deterioration. The growth of a company can also cause depreciation. Many companies begin on a small scale. As the companies grow, they often find their equipment and buildings inadequate. The use of depreciation enables these businesses to, quote, write off their old inadequate equipment and buildings. It is important to note that you cannot depreciate land. Land is an asset, but it is not depreciable. Another cause of depreciation is the result of advances in technology. Those computers that companies bought a few years ago may be in perfect working condition, but outdated. So they may need to replace them with more sophisticated, faster, and economical machines. This is product obsolescence. So the first method that we're going to discuss for depreciation is called the straight line method. The straight line method is used by more than 90% of U.S. companies as it's the easiest way to calculate. It distributes the same amount of depreciation expense over each period of time. Your formula for depreciation expense for straight line method is cost minus residual value divided by estimated useful life in years. When you do this, it will tell you how much depreciation expense to take each year. For example, Ajax Company buys equipment for $2,500, and the company estimates the equipment to have a useful life of 5 years. After 5 years, the equipment will have a residual value of $500. Calculate depreciation expense and complete a depreciation schedule using the straight line method. So the first step is to calculate depreciation expense. Cost is $2,500 and residual value is $500. $2,500 less $500 is $2,000. $2,000 divided by the estimated useful life of 5 years tells us that $400 of depreciation expense will be taken each year. So now let's prepare a depreciation schedule using this information. This is the format for a depreciation schedule for straight line depreciation. The first column is the end of the year. That tells you what year we're talking about. The next is the cost of the equipment. Third, depreciation expense you're taking for the year. Fourth is the accumulated depreciation at the end of the year. And lastly, book value at the end of the year, which is cost minus accumulated depreciation. So in year one, we see that the cost of the equipment was $2,500. We calculate depreciation expense to be $400. Therefore, accumulated depreciation at the end of year one is $400. Remember, I said in year one, your depreciation expense is your accumulated depreciation. Your book value is then your cost of $2,500 minus your accumulated depreciation equals $2,100. Year two, cost remains the same, depreciation expense is the same. This time our accumulated depreciation is equal to the prior year's accumulated depreciation plus the current year depreciation expense equals $800. Book value is then cost minus accumulated depreciation equals $1,700. You see the rest of the years are completed in for you with the cost, expense, accumulated depreciation, and book value. It's important to note that with the straight line method, your cost remains the same each year. Your depreciation expense is the same each year. Remember, straight line method, we're trying to spread out the depreciation equally over the useful life. Accumulated depreciation at the end of the year is $2,000. So our book value is $2,500 cost minus $2,000 accumulated depreciation equals $500. Does that $500 look familiar? It should. That $500 is the residual value that we're depreciating to. Remember, we do not depreciate below residual value. Here's another example. Jim Company bought a machine for $36,000 with an estimated life of 5 years. The residual value of the machine is $6,000. Calculate A, the annual depreciation, and B, the book value at the end of year 3, assuming straight line depreciation. So, annual depreciation, cost $36,000 minus residual value of $6,000 divided by estimated life of 5. Tells us we take depreciation expense of $6,000 per year. Part B asks us what the book value is at the end of year 3. So if we've taken 3 years worth of depreciation, we have taken $18,000 worth of accumulated depreciation. $6,000 a year for 3 years is $18,000. Our cost minus our accumulated depreciation gives us our book value of $18,000. Now, what if we don't buy the asset on January 1st? What if we buy it throughout the year? Well, the calculation is the same. However, you can only take depreciation for the number of months that you owned it in the first year. For example, same example, Ajax Company bought the equipment for $2,500, but this time they bought it on May the 6th. The estimated life is 5 years and residual value is $500. What is depreciation for the first year? Well, the first thing we want to discuss is what's called the 15th rule. If a company buys an asset before the 15th of the month, the company calculates the asset's depreciation for that entire month. Companies do not take 4 months depreciation for assets bought after the 15th of the month. So in this example, Ajax bought the equipment on May the 6th. May the 6th is before the 15th, so we're going to take the entire month of May for depreciation. We take it for May, June, July, August, September, October, November, and December. That's 8 months. So, first of all, calculate your depreciation expense each year, assuming a full year. Cost minus residual value divided by estimated useful life in years. We get the same $400. However, he only owned it for 8 out of the 12 months. So we take the 400 and multiply it times 8 over 12 to get a depreciation expense in the first year of $266.67. Another example. Lena Horn bought a Toyota Tundra on January 1st for $30,000 with an estimated life of 5 years. The residual value of the truck is $5,000. Assume a straight line method of depreciation. A. What will be the book value of the truck at the end of year 4? B. What if the Tundra was bought the first year on April the 12th? How much depreciation would be taken in the first year? So, A, we need to calculate our depreciation expense per year using the straight line method. $30,000 cost, that's $5,000 residual value, divided by 5 years. We take $5,000 of depreciation expense per year. Well, what is the book value at the end of year 4? Our cost was $30,000. Our accumulated depreciation is $20,000. 4 years at $5,000 a year gives us a book value of $10,000. Now, what if the Tundra was bought the first year on April the 12th? How much depreciation would be taken in the first year? First, we need to calculate how many months we're taking depreciation. April the 12th is before the 15th of the month. So, we will take depreciation for April, May, June, July, August, September, October, November, December. We'll take it for 9 months. So we'll take our depreciation expense of $5,000 that we calculated and multiply it times the 9 over 12 to get $3,750 worth of depreciation for the first year.